Hello, welcome everyone to lecture number 4 of module 11, which is going to address the forecasting of cash flow statement related to a short span of time in the future so far as the body corporate is concerned. We all know that cash flow statement is one of the most sensitive financial document which is extensively used by the users community to foresee what are going to be the likely dimensions of a particular business in terms of different aspects related to operating, non-operating, investment, financing and profit making ability of the business. When we are going to talk about cash flow statement, we all know that the transactions getting executed in a business are mostly either leading to inflow of cash at the end of the business or outflow of cash at the end of the business as a consequence to the performance of different activities. Say for example, when you are going to expend some money in lieu of performing different activities related to production, related to marketing, related to finance, related to accounting. There is the commitment of resources and there is the incurrence of cost, which leads to cash outflows. On the contrary, when we are executing an act of sales, there is the inflow of cash. On the contrary, when you are going to see to the balance sheet items, say assets and liabilities, when you are going to procure or acquire additional assets during a particular financial year, that leads to cash outflow. Similarly, when you are going to mobilize capital by floating different financial instruments as shares, debentures or bonds, that leads to inflow of cash. So that is why cash flow statement is one of the most extensively used and adopted financial statement at the end of the users community. Now, there prevails the historical statement pertaining to cash inflows and outflows, but we all know that the financial decision making process is going to be conditional upon the likely situations that is going to prevail down the line in future span of time. So, accordingly, we are also expected to foresee what is going to happen with regard to the cash inflows and cash outflows dimensions of the business, and for that projection of cash flow statement is imperative at the end of the users community. To start with, estimating the inflows and outflows of cash over a future time period is the process of forecasting a cash flow statement. The perspective objectives, the policies, the plans, the challenges, the vulnerabilities emanating from the market pervasive forces are all taken into consideration while we are going to delve into the projection of cash flow statement in lieu of a body corporate during the near future so far as the decision making window is concerned. So, when you are going to go for the projection of cash flow statement, we all know that there prevails three different sub-contents of the cash flow statement, namely the operating cash flow, the investing cash flow and the financing cash flow. And we all know also, we have already discussed these things in the previous modules, that when you are going to compute the operating cash flow or cash flow from operating activities, we are there to pay heed to the income statement, which is providing technical details about the financial items which are going to be adjusted while we are into the process of calculating the operating cash flow. Because we all know that in the income statement there prevails a number of activities or items which have been treated, but that doesn't lead to flow of cash owing to the simple reason that they may be non-operating or only mere book entry related to a particular financial transaction. So, we are there to make a lot of adjustments while we are going for the quantification of cash flows associated with all these three dimensions which represent a cash flow statement. Now, to start with the projection of cash flow statement, there prevail certain designated steps which we are there to follow in a systematic manner while we are into the protocol of projecting the cash flow statement. It starts with the access to historical information pertaining to income statement and the additional information which are made available or which are more or less considered related to a future span of time with regard to different operating activities that are expected to be executed down the line in the forecasted window. Now, to start with, the first step is the income statement projection. The income statement projection has already been discussed in the previous module, but let me make a mention of the said fact. What we are supposed to do while we are into the protocol of projecting the income statement, whether to consider the past facts and figures which are accumulated from the income statement, we are there to adjust all the items of income statement with respect to potential changes or any additional operating activity which are going to be executed by the business during the forecasted window. So, after making all sorts of adjustments with regard to income statement items, we are there to project the income statement and we are there to arrive at the profit after tax by projecting the income statement. Now, the second step is adjust for non-cash items of expenses and incomes. We all know that income statement is based on accrual basis of accounting, whereas cash flow statement is based on cash basis accounting. So, there lies a difference in the conceptual dimension of both these statements. So, the net profit arrived at by preparing the projected income statement is not going to talk about what would be the quantum of cash that is going to be generated as a consequence to operating activities down the line in a future span of time, and it is simply because of the prevalence of different non-cash expenses or non-cash incomes which have been considered while preparing the projected income statement. So, the second step leads to the adjustment of all non-cash expenses which have already been charged against the revenue, and we are there to add it back while calculating the cash generated from operating activities. Similarly, if there is any non-cash income that has already been treated in the projected income statement, we are there to subtract all those non-cash incomes owing to the simple reason that it doesn't lead to any realistic inflow of cash into the business. So, we are there to make a number of adjustments depending upon the additional information available to us and depending upon our wisdom and farsightedness with which we are going to predict what are going to be the likely conditions or situations and what changes are more or less going to be there in the execution of different operating activities, and considering all those potential informations related to or conditional upon that forecasted window, we are there to make all sorts of adjustments and we are there to compute the cash flow from operating activities after making all sorts of adjustments. Then the step 3 is estimate changes in working capital based on forecasted sales, cost and policies. We all know that when you are going to talk about changes in working capital, indirectly we are going to consider all the bunches of current assets in one hand and the bunches of current liabilities on the other hand, which are more or less conditional upon the operating activities of the business. Now, we have already projected the different operating activities related to that forecasted window. So, by making a causal relationship with that of operating activities and current assets and current liabilities, we are there to see to the changes in individual current assets and individual current liabilities, and we are there to see to the changes in current assets and current liabilities and its impact on the working capital in order to quantify or estimate the changes in working capital that is going to prevail down the line in the investment window or the forecasted window for which we are intending to project the cash flow statement. Then the step 4 is forecast investing activities such as planned assets, purchases or disposals. When we are moving to the second component of cash flow statement, it is addressing different investing activities. Investing activities simply leads to the acquisition of additional assets in the form of plant, in the form of machinery, in the form of building or any infrastructure, or investment in other businesses by using the surplus cash which is made available or which is expected to be made available down the line in the future span of time for which we are projecting the cash flow statement. So, we are there to accumulate all those activities which are expected to be executed related to the act of investments, may be in fixed assets, may be in intangible assets, may be in other instruments of companies outside the business, and related sale or purchase or disposal of fixed assets, intangible assets or long-term investments committed in other businesses. So, here we are there to take into consideration all those activities which are more or less complying to the investment activities as per the guideline provided by the regulating agencies. Then moving further, the step 5, we are there to include financing needs such as new loans, repayments or dividend plans and so on and so forth. That more or less address the third component of cash flow statement, which is popularly termed as financing or cash flow from financing activities, where we are there to see to the additional mobilization of capital by issuing shares or by issuing debentures or by floating other financial instruments. And on the contrary, that also takes into consideration the repayment schedule. It may so happen that in the past a particular loan has been taken and the maturity of the same is going to fall during that particular window for which we are intending to project the cash flow statement. So, we are there to be very careful while projecting the financing activities cash flow, owing to the simple reason that there may be the prevalence of certain liabilities which were created earlier and it is going to mature in the said period for which we are projecting the cash flow. So, they are not recurring in nature activities. So, we are to consider all those, whether it is debt source, whether it is equity source, their new mobilization or their disposal or repayment schedule. Then apart from that, we all know that when we are going to talk about cash flow from financing activities, we are there to consider the cost of each sources of capital in the form of payment of dividend to equity shareholder, payment of interest to the all the time bound sources of capital in the form of debenture, in the form of bonds or in the form of long term loans, in the form of any other instrument which is utilized by the business and that is going to be repaid with regard to their recurring payment in the form of cost and repayment of principal. By accumulating all these projected or prospective activities related to financing activities, we are there to prepare and compute the cash flow from financing activities. Now, the last step is calculate net cash flow by summing all the three sections. As I had already mentioned that the projection of cash flow statement has to be executed in a systematic manner by following a step-by-step approach. First, we are there to complete the quantification of cash flow from different activities, namely operating activities, investing activities and financing activities. Then we are there to accumulate all these three and we are there to make a face off with regard to the net orientation of all these three dimensions of cash flow statement. We are there to add the opening balance of cash and cash equivalent which is made available or which is expected to be made available down the line during that particular span of forecasted period, and we are there to quantify the balance of cash and cash equivalent which is going to be made available for that particular projected period for the business during this span of time. Now moving further, that constitutes what we discussed just now, that simply represents the modus operandi of projecting the cash flow statement in a systematic manner. Now let us move further with regard to the usefulness of projected cash flow statement, as I had already discussed the same while introducing you to this particular topic, that cash flow statement is one of the most celebrated and widely used financial document at the end of the users community, which facilitates different financial decisions serving the varied objectives of the users community, both external and internal issues. Now to start with, the contribution of or the usefulness of forecasted cash flow statement, it ensures liquidity management. One of the most formidable contributions of projected cash flow statement is that it provides information beforehand to the body corporates with regard to the quantum of cash required down the line during that particular window span to meet the short-term obligations. And this is very sensitive for the very existence and successful running of the business and performing different operating activities during that particular forecasted period. If there prevails illiquidity, implying that there is liquidity crunch which is expected to be there down the line in the future, then obviously the business is going to face a lot of hiccups and troubles while executing different operating activities. So cash is that medium through which all the operating activities are getting executed, and projected cash flow statement contributes towards that particular objective by providing information well in advance with regard to what quantum of cash is going to be made available for the disposal of different activities during that particular forecasted period. Then the next is, it supports strategic planning. Obviously, when you are going to talk about strategies, we are there to look at our peers. We are there to take into consideration our competitors in the same sector, in the same industry, who are going to compete with us in terms of different facets of business, may it be acquiring a new project or taking off new ventures or anything. We are there to compete, and we are there to be absolutely having that competitive edge to win over our competitors, and for that projected cash flow contributes heavily to facilitate the strategic dimensions of the business. Then the next is, it improves financing decisions. As I said, there may be the prevalence of the fact that certain past liabilities were created and the maturity is going to fall during that window period for which we are projecting our cash flow statement. Now, if we will come to know about the requirement of fixed capital or long-term capital well in advance, accordingly, we can be in a better position to take decisions in a rational and robust manner to ensure that we are not going to have any negative consequences or any shortage of capital during that particular span of time. So we can plan for it well in advance to meet all these requirements. Then the next is, it aids in timing of inflows and outflows. We all know when we are talking about liquidity management or working capital management, there prevails the timing of inflows and outflows of cash related to different subsections of cash flow statement, may it be operating, may it be financing, may it be investing. But the timing of cash flow is very sensitive to ensure that sufficient cash is available to provide liquidity to the business, and also at the same time sufficient cash is available to meet all those requirements of capital in lieu of acquisition of assets, in lieu of payment of interest, in lieu of payment of dividends, and so on and so forth. So projected cash flow statement is going to provide the information well in advance beforehand to the body corporate so that they can accordingly adjust the timing of inflows and outflows simply by saying, if say for example we are talking about debtors. We all know that debtor is the outcome of credit sales, and if we have allowed Mr. A, who has purchased goods from us on credit terms, and we have allowed him say 2 months of time, we can prepone. We can lead that debtor by asking the debtor to make payment before 2 months to avail of a cash discount. So that is one of the way to magnify the inflow by realizing the cash from the debtor. Similarly, with regard to payment to creditors, we can lag the payment to creditors, and thereby we can reshuffle the timing of inflows and outflows of cash if we will come to know well in advance what will be the requirement of cash down the line to perform different operating activities. Now, move further, it enhances stakeholder confidence. The stakeholders in general, I am not going to make it specific, the stakeholders in general are using cash flow statement as a barometer of digging out the state of financial affairs which is going on in the business. Because when we look at the company or a body corporate, where they are more interested to know what is the financial states of affairs of the business at present and what is likely to happen to that financial states of affairs. And cash flow statement contributes significantly to facilitate all the stakeholders to dig out or unfold those probable issues which are surrounded by the body corporate during a future span of time. So, cash flow statement and its projection facilitates a level of confidence at the end of the stakeholders when they are resorting to the task of arriving at different financial decisions there to serve their vested objectives. Then moving further, it helps in risk management. We all know that risk can emanate in a business from different sources, from different avenues when we are going to see to the future of the business, because at the very outset we all know that future is uncertain, but on that particular state of uncertainty we are there to quantify in a pragmatic manner what are the likely magnitude of different types of risks, may it be operating risk, may it be financial risk, may it be any other form of risk. Now, projection of cash flow facilitates the risk measurement of the business on a holistic orientation. May it be operating, may it be the risk of default, may it be the liquidity crunch orientation, whatever they may be. If we will come to know about the requirement of cash related to different aspects of the business, obviously we are in a better position to quantify the prevalence of the risk and its magnitude well beforehand, and accordingly we can mitigate those risks by checking out different plans, by introducing different policies to minimize the prevalence of such risks down the line in a future span of time. Then moving further, it assists in budgeting. Budgeting is one of the inherent activity which calculates well in advance the expenses in one hand and the revenues on the other hand, which are going to be having a bearing on the overall financial performance of a business when we are talking about the future states of affairs. Now, budgeting can be related to cash budget, can be related to production budget, can be related to sales budget, can be related to budgeting for long-term financing decisions, capital budgeting decisions, financing decisions. So, budgeting is the modus of quantifying well in advance what is going to be the expenses, or on the other hand what is going to be the total revenue which is expected to be generated in terms of revenue and what is going to be committed in terms of resources down the line in a future span of time. So, budgeting is more or less leading to the pre-estimation of expenses and incomes related to different activities of the business. So, in totality, when we look at the usefulness of projected cash flow statement, it is significant and formidable at the end of the users community. Moving further, even though there prevails a lot of advantages or usefulness of projected cash flow statement, but the projection of cash flow statement is not going to be free from fallacies or impediments. So, it is always a necessity to delve into the limitations or the barriers when we are going to talk about the projection of cash flow statements. To start with, we all know that when we are delving into the future of a business, we are making a number of assumptions related to different activities which are expected to be executed based on the probabilistic conditions to which the business is going to expose to down the line. So, assumptions are assumptions that are always on a state of subjectivity. We cannot talk about assumptions in a state of objectivity. So, that is one of the fundamental deficiency of projection of cash flow statement. Moving further, uncertainty and external factors. Future is uncertain and we are there to project all the items leading to cash inflows and outflows under that state of uncertainty, and that is always on a state of change that is going to be highly vulnerable when we are making our journey into the future. And the vulnerability, if it emanates from market pervasive forces or external forces, then we cannot exercise any control over the occurrence of such things. And if there is heavy prevalence of vulnerable dimensions emanating from market pervasive forces, it may so happen that our projection of cash flow statement would go wrong significantly. Then it ignores profitability. Why do we say it ignores profitability? Because there are many items which though does not lead to flow of cash, but have a strong bearing when we are talking about profitability, because profitability is one of the formidable accounting measure which is used as a financial metrics, and it facilitates different types of financial decision makings at the end of the users community. But cash flow does not consider profit on the basis of accounting dimension, which is very popular among the users community. Then it is always short term orientation. When you are talking about projection of cash flow, we cannot see to the cash flow projection for more than 3 years or 4 years. We are there to restrict our projection to 1, 2 or 3 years up to a maximum, owing to the simple reason that if we are going too far into the future, the projection of different activities related to cash inflows and outflows are going to be more and more hazy, and if we are going far into the future, then we always end up in a state of projecting a cash flow statement which is absolutely astray from the pragmatic orientation. So, always when we are into the task of projecting cash flow, we are keeping a short run horizon. Then there comes time consuming. Obviously, cash flow statement projection is a very typical exercise, and it requires a lot of time and effort and knowledge, and at the end of the users community, it may so happen that they do not have that much of knowledge, they do not have that much of time to go for the projection of cash flow statement. Then there comes prone to manipulations. Those who are having sufficient knowledge and exposure to different financial variables and their causal relationship with other variables of the financial statements, they are in a position to manipulate, to misrepresent, to go for selective disclosure of different financial variables, and they are in a position to manipulate the cash flow statement quite easily. That is one of the fundamental fallacy. Then the last one, it is difficult to update frequently, as because it is a tedious task, it is a time consuming, it requires a lot of efforts. We cannot go for projection of cash flow statement in a frequent orientation. Like say for example, if I am intending to go for cash flow projection every quarter, it is not practically viable. Theoretically it sounds okay, but practically it is not viable. So that is why the frequency with which cash flow projection can be practically executed is very restricted. We can go for a projection of cash flow for once in a year, but if the frequency is going to be high, then it is leading to spurious outcomes so far as different financial variables are concerned. So, it is one of the fundamental limitation of the projected cash flow statement. I hope we have discussed some of the dimensions of projected cash flow statement, and we have discussed the systematic approach to go for the preparation of projected cash flow statement along with its contribution or usefulness at the end of the stakeholders community, and we also touched upon some of the fundamental flaws which are there prevalent in the preparation of projected cash flow statement. Thank you for your attention.